let's get started with our topic. So on service fee is one of the things that continues to evolve, and this is one area where comparatively we as Indian tax advisors and we as some of us as Indian tax administrators have a freer hand to play with, because it is truly Indian creation, and the content is rich in India because you don't find any equivalent content around the world as such. So we took a UN concept, we evolved it, and it now finds some presence in the OECD commentary also, and it continues to evolve. So Amaya talked about the Bangalore Tribunal judgment. We've left it for the very last slide of our deck, because we ourselves are failing to reconcile some of the things that have been said in the tribunal over there, but it certainly opens a huge avenue for discussion. So we'll move into the concept, and my colleague Fahad will deal with the issues of income attribution. As Amaya said earlier, income attribution to the service fee is also something that is still evolving, because as it is a very Indian concept, some of these issues are still playing out in the Indian courts. Unlike the other articles of the OECD, we have a lot of precedents, we have commentary, there is nothing as such available on the service fee. So first let's just go through the basic concept of how a service fee results. And essentially over here, this is a special carve out which is features under the definition of section 5, article 5, and it further clarifies the definition of what is a PE. So 5.2 specifically calls out certain situations to be covered under the definition of PE, and the service fee is one of them. So 5.1 starts with the definition of what is a fixed place of business, and then 5.2 is an inclusive list of what is definitely included under the definition of PE. So a PE of a foreign company on account of presence of either employees or other personnel, and typically this is when a special carve out is resulting, because there could be situations where you are providing services and you are not covered under the regular clauses of the PE article. Now, this is probably the intention which started the UN think about a situation that perhaps a service fee is required in the inclusive list of the PE. So one example we actually find in our own Indian jurisprudence. It's an old tribunal of sale which pertain to the German treaty. Now the German treaty does not have a clause on service fee, but that tribunal decision goes on to explain, because the taxpayer in that case took a position that they were providing supervisory services for a construction contract, and the position they took before the assessing officer is that the contract belonged to somebody else, the installation place belonged to somebody else, and because I am providing supervisory services and it is not my place of business, therefore there should not be any PE at all. And there the court came to a conclusion, without looking at the service fee article, that supervisory services, and the German treaty does have the wordings for supervisory services, they said it does not matter whether it should be your place of business. And there they go on to explain, though it was irrelevant to that particular case, they go on to explain, and that is why we have a concept of a service fee in many of India's treaties. So if you are looking through the reason as to why a service fee exists, that is one judgment you cannot miss. It's a same tribunal judgment. So the next thing comes as to who are the people who are providing the services and what are the types of services that are being performed. So the first is around who are the people providing the services. It could be virtually anybody, it could be your own employees, or it could be personnel who you control, who you manage, who are under your direction. What are the services? It could be, again, any type of service. The wording is just used as service. So service would include, and as tax professionals, we always dissect the meanings of these very general terms. So services could include professional services, They could include what I would call material or trade services. Examples would be things like transportation services, shipping services, services of providing electricity, telecom services. Those could all be covered under the range of services. And then the last category, which is management services, which is typically the category which many times come about in multinational corporation situations. Then there is a qualifier to the service fee clause, which says, however, we wish to exclude services which are in the nature of either FTS or FIS, depending on the treaty. And now this has enormous significance because some treaties have provisions for FTS, for the specific taxation of FTS, and some treaties do not have provisions for FTS and FIS. And then lastly, because this is all covered under section Article 5, 5.1 and 5.2, the qualifiers which are there in 5.3, examples of places which are not going to result in a P, even though under 5.1 or 5.2 they might be specified, the preparatory and auxiliary exemption will still apply in our mind to these sort of services. Again, the service fee article has two breakdowns on it, where services sometimes are provided to related parties and where services are provided to unrelated parties, and there can be different thresholds. So, Indian treaties are actually across the board. There is no one uniform service fee definition, but they are across the board in their coverage. The next thing that we have up here is the different treaties in which the service fee clause exists and the thresholds under those treaties, and then situations where the TTAs do not contain a service fee clause, and how do you deal with those situations. So many times what happens is that if you are not covered under a FTS clause, you don't have a PE, whether you go to other income, whether you go to the service fee clause, are all decisions you have to make as you analyze your particular situation under your particular treaty. I'll hand it over then to Fahad to talk about the profit attribution.
So the concept of attribution comes into the picture once it is established that there is a presence of service fee, and the concepts are contained in the OECD guidance also, and there is a detailed attribution report policy, and similarly there are some concepts in the Indian regulations and the jurisprudence. So first we'll talk about the 2010 OECD report on profit attribution. It says, which we call it as the authorized OECD approach, it says that if there is a PE, the manner of attribution of profits to a PE is a two-step process. The first step is that you need to conduct the FAR of the PE, saying that it is a separate enterprise altogether. And while conducting FAR, you need to understand and identify what are the significant people functions, who's carrying out a significant people function, and similarly, what are the significant economic activities and where are they carried out. While doing FAR, so the functions you need to see significant functions. Similarly, on the assets. So one may say that the PE, since we just created for the purpose of taxation, legally does not own any assets. So there, rather than the legal ownership, we need to look at the economic ownership of the assets. Similarly, on the risk, in a normal transfer pricing scenario where we allocate and identify the risk, we start with the contractual agreements or the arrangements, and then we go further on the actual conduct of the party. Whereas when we are attributing profits and when we are doing FAR to a PE, we actually need to see the actual conduct of the parties which are involved in that transaction. As step 2, once the FAR is done and you have characterized the PE, step 2 is the economic analysis. And economic analysis is, as we call it in common transfer pricing parallels, a benchmarking analysis to identify what should be the return for the PE activities. And here also, I just want to highlight one aspect. as said in the BEPS report, we need to align transfer pricing outcomes with value creation. And that is what the concept here is. What is the value created by the permanent establishment? Or in this case, the service fee. That is what we need to look at. Once we identify, we do the benchmarking, that is the value being generated by the PE. Here, in addition, also want to highlight one thing, though we mentioned it initially. Article 7.2 of the OECD model, it says that PE is a separate and a distinct entity. And while taxing the PE or attributing profits to a PE, you need to consider it as totally aloof, totally separate from the overseas affiliate, from the Indian entity, and then attribute profits and go further with the taxation. Similarly, on the Indian context, the authorized OECD approach it's contained in the Indian regulations and the Indian jurisprudence. In some cases or the other. The first point we like to highlight is that explanation 1A to section 9. It talks about that profits to a business which is in India and which is a permanent establishment. How do you need to attribute profits? So I'll just read out. The income of business deemed under this clause to be accruing or arising in India shall be only that part of the income as is reasonably attributed to the operations in India. So it's also saying that only the attribution needs to be done in respect of the operations which you carried out in India. There is a circular also, Circular 4 of 2004, which specifically states that attribution needs to be carried out based on the principle contained in the transfer pricing regulation, which is section 92 and onwards. Here in Circular 5 of 2004, it also states two further attributes to an attribution or two further highlights. The first thing is that whenever you are attributing profits to a PE, the profits attributed to be a PE will be an international transaction between the PE and the head office. Secondly, as the authorized OECD approach also stated, that while attributing, you need to consider it as a separate entity altogether. When we go into the transfer pricing regulations, the definition of enterprise as contained in section 92F contains a reference to a permanent establishment. And further, the definition of permanent establishment includes a fixed place of business from where the business is carried out. Here, also wanted to highlight Circular 14 of 2001, which states that an international transaction can be between two non-residents, and out of which one non-resident has a taxable income in India. And the example there given is of a permanent establishment. So, as you can see, in bits or pieces, the authorized OECD approach is being adopted in the regulations. Now, there is also one rule, Rule 10, which has been there before Section 92 came into picture. And Rule 10 says that attribution of profits to a permanent establishment can be done based on the following three methods. So, the methods we'll discuss, but Rule 10 is an exception only in case where the profits attributed to the PE can't be ascertained properly. And three methods are presumptive method, proportionate method, or discretionary method, what the tax officer deems fit. So we'll discuss this in the slides further, but I'd like to highlight that in one of the recent judgments of the Delhi Tribunal in Hyundai Rohinton, we have discussed that judgment subsequently. The taxpayer had a liaison office in India, and that liaison office in India was compensated on cost plus basis. The assessing officer disregarded the transfer pricing report, and he adopted presumptive taxation and said that 10% of the profits are taxable in India. The tribunal rejected the assessing officer's approach and said that the SSC has maintained proper transfer pricing documentation and he has proved based on the transfer pricing documentation that transaction are advanced in, hence you can't rely on rule 2. So that is the context you want to give. Secondly, there are various case laws on profit attribution surrounding the various methods in profits can be attributed. The first one we'll talk about is presumptive attribution or ad hoc attribution. So before we go into the case laws, what do we mean by presumptive or ad hoc? Based on certain function which the tax officer says or agrees to being carried out in India, they say that this function carries this much percentage of value. Let's say somebody is doing, a liaison office is doing marketing in India, and the tax officer says that I want to attribute 15% of the profit to this function. That is what ad hoc attribution is. The first case on ad hoc attribution was of Anglo-French textile company. This is a Supreme Court case, and the judgment was passed in the year 1953. And it dates back prior to 1947, before India gained independence. And it said that there was one entity which was engaged, though a non-resident, was engaged in distribution of textile in India. And they said that this distribution was happening in British India, and hence 10% of profits would be attributed to this presence in British India. This was the first case law, and in all the attribution case laws we see, this case law invariably finds mention. Secondly, after this case law, there was a case law of Lokum Chan Mills Limited, having same sets of facts. However, the attribution in that case was 15%. After that, there were two more case laws, both by the Delhi Tribunal, in Galileo and Amadeus. In both these cases, they had a terminal for booking from India, and they said that you are booking in India, you are doing marketing in India, and hence we will attribute 15% of the profits in India. And then one of the most prominent judgments by the Delhi High Court in Rolls-Royce, and there they said that for profit attribution and ad hoc profit attribution, they gave weights. They said that 50% of the profits are attributed to the manufacturing activity, 15% are attributable to the R&D activity, and 35% are attributable to the marketing and sales activity. Since the Indian PE was engaged in marketing and sales, a 35% attribution was upheld in this case. Though this is ad hoc attribution, where a transfer pricing analysis was not undertaken. In other cases, there are case laws where there has been a reference to the FAR analysis. The first one which we have already discussed is Hyundai Rodan. The latest case in this series is of the Bangalore Tribunal in Aero Industries. And in that judgment, they said that attribution of profits to the PE needs to be done on FAR. And rather than giving weights to functions, they went ahead and gave weights to function assets and risk. And they said in any transfer pricing analysis for attribution, 50% of the weights would be for function, 25% would be for assets, and 25% would be for risk. So that is what however, they didn't comment on how much should be the income which should be attributed, but they gave a guidance on attribution and relied on FAR analysis. Then Morgan Stanley, as we all know, was on the Supreme Court. And here also, they said that since a transfer pricing analysis was conducted by the SEC and they had a proper transfer pricing documentation which demonstrated that the transfer price or the attribution to the LHPE is at arm's length based on the documentation, there should not be any further attribution. Two other judgments on proportionate adjustment, or as we call it formulary apportionment. The first one is e-funds by the Delhi Tribunal, and there the attribution was done based on assets value. So the entire profits, the value of assets in India, the value of assets abroad, and the value of assets in India, that ratio was attributed to India. Similarly, on convergees, though initially the the assessing officer started with applying formally a question where they said that I'll attribute profits based on the number of employees, but the tribunal overturned the decision and actually adopted an ad hoc attribution. This is still not finalized, but we wanted to discuss this, so we have just put it here. So, having talked about attribution, like to add, there is no clear-cut set formula for attribution. Everything depends upon the facts of the case and the availability of the data, which is anyways very important for any transfer pricing analysis. I'll now like to call our Rohinton to discuss some basic issues around constitution of a service fee.
Yeah, so far before that, if I had my attribution to be done, I would like to be in the bottom left corner of this slide rather than on the top or on the right hand side of the slide. So clearly those are cases which are either situations which preceded the TPE laws or situations where there was no opportunity given for a transfer pricing study to be put on record. But if you do face situations where you suddenly have a situation where there is a PE which is determined, as a taxpayer, it is your duty to immediately, without prejudice, put up a transfer pricing study. Otherwise, you get into the magical world of formulary apportionment or presumptive taxation, which you don't want to be in typically.
Agree.
So let's move on to a different aspect of the service fee, and that is the calculation of days. Because if you saw, one of the conditions of the service fee is the number of days during which the PE existed, whether for a related party or for the non-related party, and how long was the service provided. Now, we have clear judgments in many cases, though when we look at some of the others, you will be surprised as to how they reach their view. But in many judgments now, the question of how to calculate days for the purposes of PE is fairly settled. Clifford Chance, the Mumbai tribunal, was very exhaustive as to how it has to be calculated. They put out the submission that if we did not calculate it in the basis of what they call the solar days, as opposed to the actual man days, we would reach a kind of an impossible situation where a year would have more than 365 days. So I think the jury is settled on this. There is no doubt on this particular aspect, except what we will see in the Bangalore Tribunal's decision, where they have put a completely different spin on how the number of days is to be evaluated. So both these tribunals, and there are many others as well, where they are very categorical about the way the days have to be calculated. We then move on to a completely different category, which is many times missed out when an evaluation is done. And the issue over here is services to self. So many times the assessing officer sees visitors coming in and they ask for information as who came from your parent company to India during the period of the assessment year, especially when they are doing a PE kind of assessment. And there we give exhaustive list of the number of visits that have been received of people who have come from outside of India to visit India. And then the next question comes, what were the services that were being provided? So over here on Morgan Stanley, the case has evaluated this in significant amount of detail, and they have made a very categorical comment as to when a service fee gets constituted. So they talked about two categories of visitors. They call them the stewards and the deputationists. And in regard to the stewards, who they categorize as people who came to look after the interest of the foreign company, which is the vast majority of business visitors that some of you as tax directors of multinational companies you will have seen, that the vast category of visitors that you receive are generally people in the stewardship category. And there is very rarely a situation that you have visitors who are actually coming here to provide services. Now, where they do come to provide services, generally, again, they could be of two types. They could be the types who are on long-term visits, where they are typically coming in either as the CEO or as an officer of the company, and that's what Morgan Stanley called the deputationists. Now, clearly, we have to make a distinction between the two categories, and we'll see how the jurisprudence has evolved on the second category. So, the first category are the deputationists who have come in to act as officers of the company, who are acting on behalf of the company. Like, say for instance, you are an American company, a subsidiary of an American company, and the CEO of the subsidiary is appointed by your parent company, and he comes and he becomes the CEO of your company. So clearly there, he comes in as an officer of the company and he's performing services on behalf of the company. There is a second category of deputationists who might come for a limited period of time to provide certain types of value services to the Indian company, and there we will see how that will perhaps be tackled in different cases that we will present over here. But coming to the stewardship activity, clearly the court has held very unambiguously that no services are provided as such. These are services to the own self, and therefore there cannot exist a service fee under these circumstances. So, Fahad, on attribution, what would be the view?
Rohit actually started and said if there is no service fee, there won't be any attribution on that account.
So, if we start with the steward and we come to a conclusion that the steward, there is no attribution to be done, what happens to the other categories of visitors that an NNC would typically see?
Sure. So what we have done actually, so we have prepared some scenarios, and these are some generic scenarios which we see in a typical business MNC environment. And based on that, we have just tried to put out our thoughts on how can we attribute profits. So we have also divided this into two parts. Employees or the person coming from outside India providing services to associated enterprises, and the second one is to other enterprises. So first thing is, people coming from outside India are providing services to the Indian associated enterprise, and that service is a low value added service. Okay? And that is to be proven based on the function, assets, and risks. So we have just put out the business scenario. In that case, if it is proved and the function, asset, risk proves that it is a low value added services, the attribution should be based on cost plus markup. And the markup would definitely be a subject matter of determination depending upon the kind of activity which they are doing. Secondly, what we have seen, and it was held in the case of Centrica, the thing is, rather than attributing a cost plus markup, and where they said that the secondees who are coming in India are actually employed by the overseas affiliate, they said that in that case, the reimbursement of secondment expenses would be considered as a fee for technical services. In this type of scenario, where the value-adding activities, there are low value-adding activities, that attribution amount would be low. Similarly, let's take an example that people who are coming from outside India are negotiating contract in India. So ultimately, they'll partake a character of a dependent agent. And how do we compensate a dependent agent? Or in that functional matrix, how do we compensate a person who's doing negotiation and contracting on my behalf? So in that case, I can attribute an arm's length commission. An extended example could be that people who are coming from outside India, they are, rather than providing low value added activities, they are engaged in significant people function. They are providing strategic services, or the services they provide are significant economic value adding activities. So in that case, there can be an attribution on various parameters. For suppose, if we see that they are just providing strategic services, based on our experience, we have seen that the comparable agreements for strategic services are available. However, the commission rate which similar service provider charge a commission on the revenue. So the commission would be higher than example number 2. We can attribute a commission. That is the starting point of attribution in these cases. The end point of attribution could be based on profit split. So that would be the highest end of full-blown attribution. And as we said, that this attribution will also be dependent upon function, assets and risks. Similarly, on the second example, where people coming from outside India are providing services to unrelated enterprises. So in the first example, this is the repetition of the previous slide, since there won't be any reimbursement of secondment cost here. So in this case, the minimal attribution could be based on cost plus constant markup. Whereas, if you see that people coming from outside India are providing strategic services, high value adding services, or having a significant people function in India, the attribution could be at the match towards profit split analysis, and there the attribution amount would be the maximum. Having said that, this attribution, what we have tried to portray here, the example which we have tried to give, are some generic examples, and the manner which we attribute would depend on the FAR analysis. In addition, it's not only the commission rate or profit split method which can be used for attribution. There is no compulsion to use these methods. You can rely on any of the transfer pricing methods to the extent applicable for attribution. And continuing from Rohinton's point, what he said is that if there is a situation that the tax officer has alleged that there is a fee or a service fee, as we say, then you need to prepare a detailed attribution report stating that based on the best understanding of facts, this should be the attribution, rather than the tax officer adopting an ad hoc attribution and putting a percentage on profits to be attributable to India. So Rohit, why don't you talk about the advanced issues on constitutional service fee?
Sure. So every once in a while, our courts and even our Supreme Court comes out with a particular observation that makes us scratch our head, and we then try to justify how it works, and many times, sometimes in this particular cases, both the tax authorities as well as the taxpayers are united in probably coming to say that, well, we never thought of it this way. So in the case of the service fee, the issue has always been around furnishing of services within a contracting state. And the question comes is, what do you mean by furnishing services within a contracting state? Now, in the case of the Supreme Court's decision in the case of e-funds, a stray remark has been made around the performance and the existence of a service fee. So there they have said that the service fee cannot be constituted if there are no customers of the taxpayer that are located in India or have been receiving any services in India. And as long as all the customers have received services only in locations outside India, then service fee cannot exist. So I'll just give you the context over here. So eFunds was providing services to its customers primarily in the US, for which they had a back office center in India. The back office center in India was alleged to be a service fee for the operations outside of India, saying that they were providing services to the client. Now, this is what the Supreme Court dealt with when they gave this remark. However, if you read the lines below it, actually the issue before them was the presence of two individuals who were employees who were seconded from eFunds US to eFunds India to work as deputationists in the operations of eFunds in India. And there the court went on to make remarks that actually there was no functional analysis as to what exactly they were doing. and therefore the department's charge of saying that they were a service fee, so their activities in India were a service fee of the foreign company, were invalid. But it also dealt with the situation that the services provided by the Indian entity as a whole could not constitute a service fee of the foreign company in India, since the services were provided only in India and provided only outside India and not in India. Now, this aspect of the service fee is something that we have up until now never been evaluated, never come across. So now, while this is certainly something we can use in our defense in the future, so therefore, if today you have a service that is being rendered and you have a PE on account of that service being rendered, as long as that service is being rendered for some operations outside India, consequently no service fee in India, and that is a big departure from the line of thinking that we always had. And these are examples of stray remarks that sometimes creep into some of the orders of not just our tribunals, but even at the level of Supreme Court, which sometimes change the way the interpretation has sometimes this. So if you do rely upon this particular situation, be very prepared to distinguish your case from the case that was there before, because I suspect that the judgment can be misread in this situation. So again, Fahad, since over here there is no service fee, I'm betting you will say there is no attribution.
So it's the order of the Honorable Supreme Court. So yeah, but being a consulting professional, if somebody will see that we are providing services to customers from India and there is a fee which has been created, so in that case there is of having a higher attribution. But so it be the manner and the judgment is. So since there is no PE, there won't be any attribution.
Let's move on to another controversy that has also plagued us around the interpretation of what does other personnel actually mean. So when you look at the definition of person, does it include only an individual, or can it include a non-persona like a company, for instance, or a non-individualistic, maybe a juridical person? So, in this case, again, we have very categorical judgment of the Delhi Tribunal in the case of Lucent Technologies, where they have said that the word other personnel talks in context of individuals only, and it talks about employees or other personnel, and therefore it refers only to individuals, and therefore there should not be any other interpretation that can be applied to it. So, the contention that you can put up is that clearly other personnel should include only individuals. Now, if there are other personnel that are providing the services, that means other personnel would be people who are not employees of the company, but potentially are individuals, but are directed by the foreign company, then how would be the attribution of profit on this sort of instance?
So this is a very good example. So here when we are doing an attribution, there would be three parties. So one is the head office, then there is an intermediary forming part of other person, and then there is a PE which has been created. And what needs to be seen that the profits which would be attributed to the PE would be more than what has been paid to the other person by the head office. In case, anyways, the other person would have been paid at arm's length. If there is requirement of attribution above than what has been paid to the person, or the person has been called as intermediary, then yeah, there would be a need for attribution. However, in case the attribution is less than what has been paid to the other person, there won't be any requirement of additional attribution.
So then, the entire question begs the thought as to what will happen in the case where we do have other personnel who are individuals, but they are the individual employees of a non-individual contractor. In other words, if A Limited engages C Limited in India to provide services to B Limited through the employees of C Limited, will that be resulting in a service fee? And I don't think we have had a situation where this has actually come up for a court. But this happens all the time, where a person who is being directed by a foreign resident is actually providing services. So C Limited in this case is probably receiving an arm's length consideration. But the question that is up for grabs is, can A Limited still be considered to be having a service PE in this situation? We've talked about the secondment of employees, and over here, while we have a full session which is you are going to be going through on secondment of employees, so I'm not going to cover this in very much detail. But the question as to whether a secondment of an employee actually results in a service PE is something which is open for debate. And there have been judgments which have been for and against, and we'd like to kind of discuss as to what makes it a service PE and what doesn't make it a service PE. So the secondment typically involves the analysis of establishing who is the employer. Is it the Indian company or is it the foreign company? If it is clearly established that the employer is the Indian company, then to my mind there cannot be any service PE at all which can be attributed to it. What makes the employer, the Indian company, the employer? Well, the OECD has given detailed guidelines on this in Article 15 of their commentary, and they have put a bunch of parameters to determine what constitutes employment. Again, these have always been rooted in OECD commentary, and many courts in India have looked at these sort of scenarios and have come to a conclusion that the employer is the Indian company or the foreign company. But let's go to the case in point, which is probably uppermost in everybody's minds, and that is in the case of Centrica. Now, the secondment of employees is typically a route which can be employed very effectively by a multinational company to avoid a PE in India. So say for instance, if I am a foreign company and I want to render services to an affiliate in India, I can do two things. One, I can set up my own branch, send my employees to the branch, render the services to the Indian company, and receive my remuneration. That would be the income of my branch, which is a PE, and I would end up paying taxes on the PE. Let's assume the services exceed 183 days and would definitely constitute a PE. The second situation is, if I were an MNC company and I don't want to have a PE in India, what is the way I can render these services? I can depute those technical resources that I need to my Indian company and allow them to become employees of the Indian company, and in that process render the services to the Indian company. Now what happens in that situation? Granted, in both the cases the remuneration of those deputed employees would be taxable in India, given that they are in India for a period exceeding 183 days. But what happens is that I am able to probably take a position that the reimbursement of salary is not taxable. I have avoided a PE of the foreign company. And these are typically situations that have been called out by India and some of their commentaries to the OECD treaty. In the case of Brazil, they have gone and very emphatically stated that the secondment route is a route which can be very easily be used by foreign companies to avoid a PE. And typically these are high-risk areas, especially where we have seen where the employees are here in India for a very short period of time. Typically this happens where a new factory is being set up and you need 20 very technical employees to come to India, set up the factory and then go back. They're usually there for about a year or so. So one option is second them to the Indian company, no PE, no problem, reimburse the salaries, end of story. Or actually have a PE in India, and most MNCs will opt for the first instance where they will do a secondment. Now these are areas where typically the tax authority has gone and scratched the surface as to what is the relationship between employer and employee. And if you look at Centrica's case, it is actually rooted in a situation where the services provided by the employees were very technical resources were actually made available to the Indian company. So disguising a secondment agreement, disguising the provision of technical services as a secondment agreement can lend you into a Centrica type of situation. And lastly, we come to our latest judgment of the Bangalore Tribunal, where we talk about a virtual presence being there on account of a service fee. Now, this was a particular case under the UAE Treaty. The UAE Treaty has a service fee clause but does not have a clause taxing FTS. So, in this case, when the employees came to India, the position taken by the assessee was that there was no article taxing FTS, and unless there is a PE of the foreign company in India, they cannot be taxed in India. Very reasonable position. In fact, the employees were in India just for 25 days. So there was no question of a PE also arising. So the court actually, the tribunal in this case, actually went through the analysis and came to the conclusion that while it was not necessary that the employees had to be in India for the entire duration of the provision of services, the article talks about the provision of services in India. If those employees came and went away, the services in India continued through the entire duration, and that duration exceeded the period in the treaty, which was 90 days, and consequently a service fee still resulted. Divorce of the presence of employees in India. Now, this is a drastic departure from all the other judgments that I have talked about. We talked about the solar days, where we had to count the number of days in order to arrive at the number of days. Here, the tribunal says you don't even have to count the days of the presence of the expats. You have to count the days of the number of days that the service was provided in India. And if the service was provided through video conferences and they continued for a period exceeding this period in the service fee article, there would be a service fee in this case. Now, this again opens up a plethora of things to consider. And if you have a situation like that where the foreign company is simply providing services to you, and maybe one expat came in and visited for one day, you have a service fee based on this judgment. Also, this could be an excellent way for the tax department to even tax certain e-commerce type of activities in India, because this opens and in fact they did try it. If you see some of the web's commentary, they did talk about the service fee being used to be able to tax e-commerce situations. So again, this is something which has completely upset the apple cart, and as I said, this is an Indian creation, so we have the right and the ability to go and explore it in the fullest possible area. So Fahad, how will attribution happen in this case?
So Rohinton, the principles of attribution still apply and could depend upon the nature of service, and starting from cost plus to a revenue or profit split. However, if it is proved that there is significant economic presence, the attribution will be very high-risk. So depending upon the facts, actually, it's going to vary a lot.
So I would argue a little otherwise. So I said that the attribution has to be done as to regard to what are the activities carried out in India. If the activities for the service are carried out outside India, the attribution should still result in zero amount being attributed. So with that happy note, maybe we can, this was our last slide, so we'll summarize very quickly. So we have the service fee. It's a very much an Indian creation. Attribution is something that is still being evaluated, and we have a lot of judgments which give contrarian views to what we would normally interpret a service fee into this. At this point of time, I don't think we have time for questions, but we'll be happy to take questions later behind the scenes. Thanks very much.